Hello and welcome. Today is June 30th, 2022. It's Thursday. I was reminded of this article today. It was released almost 3 years to the day, June 29th, 2019. It was published by Yoon Lee of CNBC. And notice this headline: 80% of the stock market is now on autopilot. She's mentioning the stock market. Now, around that time, a few months earlier, the CFTC, the Commodity Futures Trading Commission, had put together a study, had released this report, and they wanted to compare the impact of automated automated orders in the futures market. And so as you'll note, a report by the staff of the Market Intelligence Branch Division of Market Oversight, okay? And so this is part of the CFTC. So they essentially studied this, and they, put a lot of energy and time. This was a 6-year study. They started it in 2013. And ultimately, this is the conclusion they came up with. So you don't have to look at all the charts, and they have it broken down in lots of different ways. Very interesting if you get a chance. And I'll put a link to this in the description, so in case you want to take a look at it. But this is the part that I wanted to quickly discuss to further bring home the point that I'm about to make. This research examined the effects that manually and automatically entered orders had on futures markets. Remember, the CNBC one was the stock market. On futures market over a period of 6 years, DMO staff observed that automation has increased consistently over the study period. Now, if in 2019 we had 80% of the market 3 years ago, and we know that it has increased consistently, and I'd like to add my own anecdotal evidence. I have hundreds of clients here that are using my systems. I've spoken to hundreds of people with respect to automation, and what I've noticed is there is not just an overall increase, which you expect it to be the case on the commercial side, but I'm seeing it on traditional retail traders who have traded probably for decades manually. Traders that have relied exclusively on various indicators. And some of those traders had tried to use some sort of ATS, some sort of automation in their indicator-based trades, have now moved to algorithmic trading that's quant-based. Okay? Now, the industry on the commercial side, 2019 data showed that the industry was spending $39 billion with a B on data. So the industry's essentially buying data at a very expensive cost, because you can use that data and place trades with them. Now, imagine if you're on the industry side, if you have a fund, whether it's a hedge fund or a commodity pool fund, any type of fund, and you're trying to manage money for well-to-do clients. Imagine if you approach those clients and you said, Mr. and Mrs. Client, I have an RSI indicator that I've combined with a stochastics indicator, which I've combined with a VWAP, which I've combined with market profile, to come up with an indicator that I deem to be the indicator of indicators. I want you to give me your money and pay me 2 and 20, meaning 2% for management and 20% for performance, because I have this super duper indicator on steroids. I sincerely doubt, unless that fund's name was Goldman Sachs or someone like it, anyone is going to give 1 penny for that firm to manage. The reason being, the response or the objection to that offer, the counter offer, if you will, would be something like this: why would I give you money, 2 and 20, to give me indicators that are essentially free on nearly any trading platform? What gives me an edge so that that 2 and 20 that I have to pay you would be warranted. Meaning I would have some sort of value if I give you that 2 and 20. Well, there is none, is the answer. There is no edge. Because everybody, people that just started trading yesterday, that started watching YouTube videos and took a bunch of courses and spent all this money on indicators and how to use those indicators, are using indicators that are available for free for everybody. And so whether you went and paid for the indicator and you bought what they call a premium indicator, which is essentially just still an indicator that's perhaps combined a grouping of indicators and has changed the coloring of how the chart loads, and it looks really cool. It looks very impressive. But in the end, it's just studying current price action. It's not studying $39 billion worth of data, the historical data that the commercial side is studying. Okay? Because there is consistency that one can find if they study historical price action, particularly if you're trading or one is trading on a short-term basis, meaning they're day trading. Okay? So if you want to be in and out of the market before RTH close, before the market closes or before cash close, then not to use a quant-based automated system, in my opinion, makes no sense. Okay? So the reason it doesn't is that it is the same reason that one would have if they were, for example, going to go to war. Okay? If country A is going to go to war with country B, and country A knows that country B has these very impressive weapons, very impressive weapons that country A does not have, it would behoove country A not to go to war and instead perhaps propose some sort of peace agreement or treaty so that they can avoid war because they can't win that war. And so it's the same thing. When you're going to battle in the trading landscape against, we can assume approximately 90% at this point of bots, I mean, you are at a serious disadvantage. Okay? Now, granted, most of those bots on the retail side are not going to be good. Okay? Why? Because they're going to use just indicators or a confluence of indicators being combined together to come up with some signal based on current price action while they ignore everything that's happened historically. So in my system, Price Action Harvester Automated version 4, which makes what is very unique about it is that I break down everything over a day and time. And so just think of a graph, a chart, and think of your X and Y axis. Now on the X axis, plot your day. On the Y axis, plot time. So in this example that I've loaded here, if you can see my cursor here, so for Monday, between 6:31 and 6:54, this is Pacific Standard Time, I'm in Los Angeles, the system is looking for short trades. Now this is for CL, okay, crude oil. Between 7:36 and 7:59, it's looking for long trades. Between 8:36 and 8:54, it's looking for both because there was no edge there on either side. Between 9:06 and 9:24, it's looking for long trades. And 9:31 until 9:59, it's looking for both again. And it stops looking for trades after that. Okay? So this information that you see here is based on historical data. Now the system isn't just going to enter a trade strictly based on historical price action. That would be silly, especially when we have current price action that we can also study. So in this system, Price Action Harvester Automated version 4, I have combined historical price action with current price action. So if the current price action is in line with what happened historically, then the system will enter a trade. And there's a lot that goes on to the current price action strategy. Now, people often ask me when they look at this, they say, well, how did you come up with these times? Right? There are two ways. One is hard work, which I've done, years of work. And two, I built an analytics tool, again for NinjaTrader. This system runs on NinjaTrader. Let me show that to you. So it runs off of Market Analyzer, which is included in NinjaTrader 8's platform. And so let's go ahead and show you what I mean. So I'm going to go and load a template. Today is Thursday, so I'm going to load closing hour for the last 12 Thursdays. Okay? And you're going to see the data load here. You'll notice things like up percent, as in what was the percentage where price moved higher. This is obviously the opposite, price moved lower, etc. And then you have the maximum moved up, the maximum moved down, the minimum it moved up, the minimum moved down, the average when it was price moved higher, the average when price moved lower, and then you have the mean, the sum total, and then what gets interesting is the 1, 2, and 3 standard, so 1, 2, and 3 standard deviations from the mean. And so a lot of people focus on this, okay, and they miss the sort of the meat of the bone, which is right here, okay, right there. So a lot of 50s here. What I typically do is I ignore that, okay, and so what I do is I come here and I just say let's add a condition where if it equals to 50, then I want to hide. Same thing on the down. If it includes 50, I want to hide it, and it's very easy in NinjaTrader to do this. So the tool that I developed, the analytics tool, it's an add-on indicator. It's called Price Action Harvester. And once I run this here, you're going to see all those guys disappear. And so here I look at the up and down percentages, but I also look at the mean. Okay, I'm looking here. So if I was going to take a short trade, I'm looking at the average down, the mean, and the standard deviation from it. And so let me show you how many templates I have for this thing. It's a lot. So all of these you'll notice is being broken down by the day and by the hour. So there are a lot of templates here, so I don't have to readjust my parameters every single time. And so I showed you the columns. So I said this is for Thursday. This is the last 12 Thursdays between 12 and 1 o'clock. Okay, so it's military time, and this is Pacific Standard Time. So this is the last hour, the closing hour. Okay, how price moved for these instruments, NQ, Bitcoin, crude oil, natural gas, gold. For those instruments, how price moved on the last 12 Thursdays. Of course, that's just a simple example. I have 30-day look, a 30-week look back, 15 look back. You can have a 2-year look back. It's all up to you. Okay, and so based on that, one can make an assessment as to what are the quote-unquote better hours to trade. Which hours and which days gives you an edge. Now, I have a lot of templates for instruments as well. I have loaded CL here, but as you can see, I have Bitcoin, crude oil, SPOOs, the German index, the FDAX. I have the Eurobonds, gold. I have a bunch of agricultural ones like feeder cattle. I have soybean. I have wheat. I have corn futures. I have silver, RTY, lots of different ones. Okay, copper. So the idea here is to pick the best instrument to trade after studying a group of these guys. I have 26 instruments here. But let's say you were to narrow that down to just 10 instruments. You would essentially run, you'll see on the bottom here, Analyzer 1, 2, and 3. This is the backtesting feature called Strategy Analyzer for NinjaTrader 8. You would essentially load these templates, run them one by one just for Monday. So if I wanted to see which instrument I should trade, CL, ES, gold, silver, etc., which one should I be trading? Well, I'll load the CL template. I'll load the ES Monday template. I'll load the GC, which is gold, Monday template, and so on and so forth. And I'll do that on separate strategy analyzers, and I'll click run. And based on the data that I get back from the back tests, I will make a determination as to what I should trade that particular day. Because believe me, there are good days and bad days to trade any instrument. And when I say believe me, don't just believe me. Don't just believe anybody who says believe me. You should still trust but verify. The data clearly shows what I'm saying. Okay? When you run it, you'll be able to see that. And if you need me to show that to you, I can certainly do that. Simply ask for a Zoom demonstration from pinnaclequant.com. Fill out the form, and we'll set up a time for you and schedule a private demonstration for you so that you can see exactly how the system loads and how the system backtests. Now, another question that I get is with respect to the backtest. They'll say things like, how do we know that this backtest is accurate? How do we know that you're not curve fitting this? Well, whatever I backtest, I do minimum of 3 years. In this example, I have 3.5 years, really, because it's going from January 1, 2019 until the year 2099, which includes today. Today is June 30th, as I mentioned, 2022. So it's looking back 3.5 years. I always include slippage, and I sort of tailor that slippage based on what I typically see on that chart. So CL is pretty tight on the slippage. It's usually 1 tick slippage. On something like NQ, I put in 2 tick slippage because NQ is a little bit sort of the spread has a bit more variance between the ask and the bid. If it was the Bitcoin futures, I'd put something like 7 ticks because the variance there is insane. Okay, it's very, very high. And so it all depends. You have to sort of tailor it around what you typically see during regular trading hours. So if there's plenty of liquidity, you can expect tighter markets. If there is not enough liquidity, you're going to get variance in the ask and the spread. That's pretty significant. Okay, so this system uses market orders for the entry. Some of the exits are market orders, and profit target, of course, is a limit order. So it is quite unique versus all of the other systems that I've looked at. So not just because it has money management features, a lot of the systems, the good systems, have money management features, but it's got unique features in that it's based off of historical price action. So that's the foundation. It's not only historical price action, that would be silly, but it is based on it. And that is something that already differentiates my system, Price Action Harvester Automated, versus so many of the systems that I've studied, okay? This is something that on the commercial side, and I am a licensed, I do come from the commercial side. I'm licensed, I'm a commodity trading advisor. I'm a member of the NFA. I am regulated by the CFTC. So I have unique things here that other systems don't have. For example, you'll see move stop here. A lot of people think that's a trailing stop. It is not. I stopped believing in trailing stops years ago. And the reason for it is because the market is way too choppy. And the funds, the algorithmic systems that are out there are trying to take advantage of what people on YouTube have shared in their videos. Retail traders, the gurus, have shared in that they'll say, for example, put your stop at below some support level and put your target a little bit below or at around a resistance level and so on and so forth. Well, that is exactly what the funds, the algo trading systems are going to look for to take advantage of. Just think of it this way. Let's say in the initial hour of trading, so 6:30, 7:30 Pacific time or 9:30, 10:30 Eastern, you have 100 million worth of transactions, $100 million worth of transactions. So let's say you're trading the SPOOs, the E-mini S&P 500 futures, and you have $100 million worth of transactions during that hour. If price has moved above a certain level and there are a bunch of orders near or slightly below a support level, one can comfortably assume that those are stops. So if I'm a fund and I'm managing, let's say, $5 billion, and I see that if I put into this market $300 million and drive the price down, I can take out all these stops and then put in, I don't know, $600 million and take the price up again. And all those stops have been taken out, and now I can tell my employer, because let's assume I'm the algo developer for this fund, okay? I'm going to tell my boss, look what I did. I got you a bunch of orders at this buy price. Market had moved way above it, but I got it for you at what others had their stop at. When do I get my raise? And so this is what they can do all day long. Okay, they can play off the resistance and support all day long, and that makes the market choppy, and that makes a trailing stop. I say all that to say that makes a trailing stop nowadays, in my opinion, a moot point. You leave a lot of money on the table when, in my view, you use a trailing stop. So I don't use a trailing stop. Move stop is very unique. Again, during that demonstration, asked me to show that to you. And so I have risk management features in place here, several of them, not just from a money management side, but also from actually the move stop, the risk per trade, which is the stop here. And then I don't even, in this system, if you keep these two checks, these two boxes checked, the system will review the near price action, the near to entry price action, to see if the stop that you have in place, which in this case is 15 ticks, is enough for the market that you're about to enter. If it's not, it just skips the trade altogether. If it is, then it enters the trade. It is a very unique system. And then in version 3, I did not have this, but I added it in version 4, and I've received, thankfully, many compliments for it, is special operations. So special operations is for those traders that are trying to take advantage of some unexpected news or geopolitical event that's happening in the market that day. So I'm not saying necessarily trade on a Fed Wednesday, because volume becomes very anemic on those days and there is additional risk when you trade those days. But there are plenty of other chances that one can have, especially since this war started in, I believe it was February, between Russia and Ukraine. Then it's been, in my opinion, at least from what I've seen, the single best time to be a day trader because of the unbelievably good volatility that we've had. When I say good, it's bad overall if you look at it from an investment standpoint, but if you look at it from a day trading standpoint, I mean, this is what day traders want. This is what they live for, okay? This is like why they wake up early in the morning. So this is a fantastic opportunity. In special operations, you'll note, unlike the other entries here where go long and go short, this one, it reads go long event driven, meaning you found an event that you think you should go long or short on. And so let's say you believe that the initial open, so from 6:30, 7:30 or 9:30 to 10:30 Eastern time, you're going to have some volatility because of some news that came out, let's say half an hour prior or an hour prior. Then even if you don't know the direction, if it's going to go higher or lower, you can select both, input that time in. I always like to put 1 minute after and 1 minute before that hour closes. And so let's say you put that in, and now you can manage it. You can do the same, for example, the closing hour, the same thing. But you have the opportunity now to manage it, okay? Meaning you can say, I know exactly what my stop is going to be, okay? I'm going to use the strategy of special operations, all right? And I know exactly what my stop is going to be, my profit target is going to be, when the system is going to stop trading. If I have so many consecutive losses, I can say 2 consecutive losses. If I take 1 loss, then stop looking for trades. Or I can keep it as 3, whatever you would like. And then you can set to see what the numbers are. So if you're down 390 net, minimum 390 or more, meaning, then the system will stop looking for trades. Same is true if you hit $4,000 here in this example. So if you hit $4,000 and you're up $4,000 during that day, upon the system going flat, if you're up at least 4,000, then it's going to net up 4,000 during that session, then it's going to stop looking for trades. So you can manage this and take full control of it. It's got an exit where it's going to, no matter what, plan everything at 12:59. So now you don't have to be emotionally connected to your trade, which if you're a human being, no matter how much you practice this, and guys, I've seen this, people make this mistake for years and not learn. Literally for years. Every day they make this mistake, or not every day, but when they make this mistake, they tell themselves, well, I'm not going to let that happen to me again. I moved my stop. I got emotionally connected to my trade. I'm not going to do that again. Give it about 2 or 3 months. That opportunity comes again where they can move the stop because they get nervous about something. And guess what? Right when they move it, they remember that they made that promise, and now they get even more nervous. And it's just a matter of time until that stop gets taken out, and they're right back at it again. We are human beings. There is no way we're not going to be emotionally connected when there's money potentially to be lost on the line. There's no way. I don't care how long you've been trading. Okay? If you've been trading, you're alive, you have a heartbeat, you're going to have emotional mistakes. Even if, let's say, you've been trading for 40 years and now you've got ice running through your veins. If your dog is sick, your loved one is sick, if the roofers did a bad job and you have a leak, something's gone wrong with the plumbing, external issues around you are going to throw you off kilter, and you're going to likely make a mess. You're highly likely to make a mess of that trade because you have external factors that are impacting your mind, even if you have ice running through your veins. Your mind is still operating and thinking about those external factors. What if you're sick, for example? Are you still going to be able to perform at the same peak level as you were performing? All it takes is one mistake to go from a winning month to a losing month. One big mistake, and that's it. And so you do have to be careful. That is why I strongly believe that no one should trade in this market with this kind of volatility without a quant-based automated trading system. There are literally tens of thousands of automated trading systems out there. Tens of thousands, okay? A great majority of them are not investable, okay? Some of them are built on Renko bars, which make the backtest moot, null, because Renko bars, when backtests, particularly in NinjaTrader, are calculated, they're going off of OHLC data, open, high, low, and close data. So you do have to use regular bars, okay? You have to use the typical 1 minute bars, which is my system. It runs on 1 minute. So the information that NinjaTrader and most platforms are recording, they're recording the tick data too, but when they're doing it off of their backtest so that the backtest is not molasses when you run it, it's moving, relatively quickly. They're going to store the open, that number right there, the close, and let me pick another bar so I can show you the details. So the high and the low, okay? That's the 4 pieces of data on each bar that they're going to record. And that is what these backtests from my backtests on my systems run on. So to answer that original question as to what a long-winded answer, huh? To answer that question, it is quite accurate, especially if you add slippage to this. Okay, it becomes, slippage. All right, so again, slippage should be adjusted for the instrument that you're trading. BTC slippage should be, in my view, around 7 ticks, NQ around 2 ticks, and for CL, 1 tick is good enough. Same with ES, I think 1 tick is good enough. So it all depends. And the way you study that is very simple. You just look at the chart and see. So take like you see, let's take a look at the data. So here's the data box from NinjaTrader. So you'll notice that here's the close. It's 106.62. And the open on the next one is 106.61, 1 tick. Okay? And that's pretty customary over and over again. You'll see between the open and the close is 1 tick. Okay? And so generally speaking, it's not always going to be 1 tick, but generally speaking, it's going to be 1. And sometimes, remember, you get negative slippage where the slippage is in your favor, okay? So, and then the other thing you want to account for, which is a small amount, but it's commissions. So if you're going to pay, let's say, $4 round trip, add that as well. But then you have a very accurate backtest, okay? It's never going to be 100% accurate. That's not possible, but it'll be somewhere like in the 90th, 95 percentile, something like that as far as the accuracy goes, okay? Which is good enough to make a determination when you're running all of the backtests for the various instruments for that particular day as to what you should be trading. And how do you make that decision? I'm not going to run it here in this video because I want to save that for a Zoom demonstration. But the number you want to focus on the most is not your net profit, which is what everybody's eyes typically goes to. So when I run a backtest, I see that most people will look at that, total net profit. But I always remind them, make that the secondary view. Okay, the initial view, the initial thing you should take into consideration is this, the max drawdown. So if you have, let's say, a $4,000 max drawdown, this is just a hypothetical. If you have a $4,000 max drawdown, the question you as a trader should ask yourself is, can I afford to be down $4,000? If the answer is 4,000, that's nothing. I lose that in a weekend in Vegas. Okay. If the answer to that question was like, yeah, that's fine, I can be, then okay. Then you can look at a $25,000 net profit if that's what it showed in that backtest and go, I'm okay being down 4,000 because I'm looking for that hopeful return of that 25,000. So I'm looking for that. This is just a hypothetical, guys. I'm not even run a backtest here. But and hypothetically, if those numbers were there, 4,000 on the max drawdown, 25,000 on the total net profit, and you're okay with that, then you should be good to go, in my opinion. But if you look at that 4,000 and you go, I can't afford to be down 4,000, well, that's not the instrument that you should be trading. There are instruments that have far less volatility. Bond futures, for example, corn futures, wheat futures, etc. Okay, there are other instruments that you could be trading. Or if you still want the volatility, but you don't want to pay or you don't want to be down that much, then most of these instruments have the micro version. So, Bitcoin has it, oil has it, ES has it. Just add the M in front of it. So ES would be MES, so the micro ES. NQ has it, and so on. So they are at a tenth of the value for each tick. So I'll give you a few examples here. ES is $12.50 per tick. That's the SPOOs. Well, the MES, the micro ES, is $1.25 a tick, right? NQ is $5 a tick. MNQ is 50 cents a tick. Okay? Oil is $10 a click. CL, not a click, $10 a tick. But MCL is $1 a tick. Okay? I hope that makes sense. So you could trade those instruments and see if instead of $4,000 in that scenario, it'd be closer to $400 that you'd be down until you started recovering again. So those are the things you want to take into consideration when you're trading, and you want to give yourself an edge. You want to give yourself a historical data edge. You want to give yourself a full understanding of what happened historically when you run these back tests to how much you were down in the account. What was the max drawdown? And make a determination to find out what is the best possible day based on the back tests to trade particular instruments. Okay? That way, when you're trading, you have a full understanding of what's happening. You're emotionally detached from the trade because you are letting the system run it for you. Hope this has been helpful. If you enjoyed this, give me a like. Feel free to leave a comment. I do look at those once in a while to be able to respond to those. So until then, take care and God bless.